Free cash flow is often described as the most honest number in finance. Earnings can be adjusted, accounting can be massaged, but cash, we are told, doesn't lie. That idea alone has convinced more investors than almost any spreadsheet ever has. And that is precisely why free cash flow deserves closer scrutiny. Because cash feels final, it feels objective, it feels immune to interpretation. If the cash is there, the business must be healthy. But that confidence rests on a flawed assumption that cash generation is automatic. It isn't. Cash is not something a business discovers. It is something a business produces through decisions. Decisions about investment, decisions about maintenance, decisions about timing, and decisions about trade-offs. Those decisions shape cash flows just as much as revenue does. So when investors say cash never lies, what they actually mean is this: I trust this number more than the others. But trusting a number is not the same as understanding it. So the danger is not that free cash flow is meaningless. The danger is that it feels rather conclusive. It gives the impression that the analysis is finished, when in reality it is only just beginning. Free cash flow is not a natural state. It doesn't appear automatically. It emerges after a series of choices. Choices about how much to invest, what to maintain, what to defer, and what to prioritize. Those choices are rarely neutral. Free cash flow is calculated by taking operating cash flow and subtracting capital expenditure. That subtraction is where judgment lives. What counts as necessary spending? What can be postponed? What is labeled as growth rather than maintenance? The formula looks mechanical, the inputs aren't. Before going further, it is worth being explicit about how free cash flow is actually built up. Free cash flow doesn't appear on the income statement, it is derived from the cash flow statement. In simple terms, the cash flow starts with operating cash flow and then subtracts capital expenditure. Operating cash flow itself starts with net income and then adjusts for two things. First, non-cash items such as depreciation and amortization. These reduce accounting profit but do not consume cash, so these are added back. Second, changes in working capital. This is where many investors lose clarity. If receivables increase, revenue has been recognized, but cash has not yet been collected. Operating cash flow falls. If inventory builds up, cash has been spent without generating revenue yet. Again, operating cash flow falls. If payables increase, on the other hand, the business delays paying suppliers. Cash is temporarily retained. Operating cash flow rises. None of this changes reported profit. All of it changes cash reality. So when we talk about free cash flow, we are not talking about a single objective truth. We are talking about the combined outcome of accounting profit, non-cash adjustments, and timing decisions around working capital. That is why free cash flow can move sharply even when the underlying business has barely changed. So free cash flow is not a fact about the business. It is a snapshot of management decisions at a point in time. Two companies with identical operations can report very different free cash flow figures depending on how aggressively they invest. The number reflects behavior, not just performance. This doesn't make it useless though. It must be interpreted carefully. When investors treat free cash flow as a conclusion, they mistake an output for an explanation. Now that we are clear on what free cash flow is trying to measure, we can look at the first major distortion, the line between maintenance and growth. In theory, capital expenditure falls into two neat categories. Maintenance spending keeps the business running, growth spending, on the other hand, expands it. That distinction sounds clear. In practice, it rarely is. Replacing aging equipment can be framed as maintenance. Upgrading systems can be framed as growth. Expanding capacity can be framed as optional. The labels are flexible, and flexibility creates room for distortion. A company can increase free cash flow simply by redefining what counts as necessary. Maintenance is delayed, upgrades are postponed, investment is pushed into the future. Free cash flow improves. The business looks healthier, but the underlying economics haven't improved. This is why free cash flow often looks strongest just before problems emerge. Underinvestment flatters cash generation in the short term, but over time it shows up as falling competitiveness, margin pressure, or sudden spikes in capital expenditure. Free cash flow doesn't warn you when this trade-off is being made. What looks like discipline can be deferral. What looks like efficiency can be erosion. And the number doesn't tell you which one you are seeing. Capital expenditure is not the only lever that can flatter free cash flow. Working capital is another. Free cash flow improves when cash is released from working capital. That can happen when inventory is reduced, customers pay faster, or suppliers are paid later. All three increase reported cash flow. None of them necessarily improve the underlying business. These effects are often temporary. Once those levers are exhausted, the benefit disappears, and sometimes it even reverses. This is why professionals never look at free cash flow in isolation. They want to know where the cash came from, whether it can repeat, and what had to change for it to appear. At this point, it is also worth clarifying what people mean when they say free cash flow. Sometimes they mean free cash flow to the firm. Sometimes they mean free cash flow to equity. The distinction matters, but it doesn't solve the problem. Both depend on assumptions about reinvestment. Both can look strong for reasons unrelated to long-term economic health of the company. Changing the label doesn't remove the need for judgment. Finally, there is the issue of time. Free cash flow is rarely smooth. It moves in bursts. It spikes, it collapses, it reverses. A single strong year can look very convincing. On its own, it tells you very little. This brings us back to the broader pattern. Price to earnings ratio compresses expectations into a single number. Return on equity rewards leverage. Free cash flow hides reinvestment and timing trade-offs. Each metric promises clarity, each delivers comfort instead, and each quietly relocates risk somewhere else. If this way of thinking resonates, skepticism over shortcuts and judgment over formulas, then this channel is probably for you. Subscribe if you want to keep building that lens, and I'll see you in the next video. All the best.